Welcome to the Thomson Reuters Idea of the Week and Alpha Now. I'm John Cozy. With the end of the year in sight, it's time to visit our StarMine quantitative quarterly outlook for the S&P 500 sector by sector. We hope you find it useful as you prepare your own roadmap for 2013. We took StarMine model scores for each company and applied their market cap weight to get a composite look at each sector. Here are some takeaways. In the possible crowded sector category, the winner is consumer staples. As you can see from the green boxes, consumer staples claims the number one rank in 5 out of 6 StarMine models and number 2 in a 7th model. The markets noticed it too. It has the highest price momentum score of any sector. Plus, it's got the tightest spread between earnings forecasts and what current market prices are implying about earnings growth at under 2%. In our most unloved category, the winner is energy. It has the lowest implied earnings growth of minus 2.4% for the next 5 years, according to current market prices. It's even worse than the utilities, which isn't exactly a growth sector. Energy's best performance among all StarMine quant models is a number 2 rank in the short interest model, which is actually a positive. In the highest 5-year forecast growth category, financials takes top honors. Analysts put earnings growth at 12.4%, far outpacing number 2 consumer discretionary, and that's after StarMine adjusts for positive bias in growth forecasts. The financials are perhaps the most uncrowded sector as well, with the largest spread between analyst and market implied growth rates. Financials seem tugged in opposite directions, with 2 number 1 model ranks and 1 number 2 rank. But it also shows bottom ranks in 2 credit default models. Speaking of weak ranks, consumer discretionary comes in at the bottom of all sectors in both relative valuation and intrinsic valuation, and without any top ranks. This sector looks relatively expensive. And take a look at that second highest 5-year analyst earnings growth forecast of 9.4%. The implied growth of 6.3% creates the second tightest spread of all the sectors. Now, for those who may want to sleep well at night, telecom services might be an option. AT&T and Verizon, with their fat dividend yields, are 80% of the sector weight. Telecom ranks number 1 for value momentum and relative valuation, and with no last place ranks. That said, there's still a lot of uncertainty about how investors will treat higher yielding stocks pending the outcome of the income tax rate debate in Congress. For the Thomson Reuters Idea of the Week and Alpha Now, I'm John Cozy.